So if I asked you before this year what Shaq, Gary Cohn, Bill Ackman, Paul Ryan, Colin Kaepernick, A-Rod, Ciara, and Chamath all have in common, you might have said something like they're all wealthy, or maybe they express political views that you agree with or disagree with. But as of this year, and really last year, there's another answer to this question, which is that all these celebrities have SPACs, or special purpose acquisition companies, or as I call them, scams, which is probably a better abbreviation than SPACs to describe what they really are. Lately, we've been getting many questions about SPAC models and SPAC valuations and how to think about this. And the truth is that, like a lot of overhyped nonsense in the current financial markets, there is very little to SPAC models. So in this tutorial, we're going to cover SPACs, show you what a SPAC model in quotes might look like compared with a traditional IPO model, and explain why special purpose acquisition companies are mostly scams that reflect a massive market bubble that we're currently in. So as I call it, this tutorial is all about the great SPAC scam, or how to fool most of the people all of the time. Now, the short answer to this question is that SPACs are primarily a way for wealthy celebrities and investors and former business people to get huge chunks of actual businesses in exchange for doing almost nothing in terms of time or money. Once a SPAC is raised, the sponsors could raise capital and then do absolutely nothing with it. Banks, of course, love this because they still collect their fees because of the SPAC going public and charging a fee on that. And if you invest in it, you could potentially get nothing except for your money back at the end, which of course is worth less because of inflation. SPACs are often pitched to companies as a way to allow them to go public without the normal regulatory oversight in an IPO. As we know, of course, that reduces the risk. Heavy sarcasm here. They're also pitched as a way for companies to go public more quickly and for lower fees, which, as we'll see, is not exactly true. And then for you as a retail investor, if you buy SPAC shares, you're essentially getting an empty company with no track record, and you're betting that maybe a celebrity or two might eventually find a single company that is so good that it justifies buying shares in a completely speculative bet. So that's the quick version of this video, but let's go into this and I'll show you what we're going to cover here step by step. I want to respect your time, so I'm going to show the timestamps for each of the segments here as well. So first we'll go through the SPAC process and mechanics. It's best to think of this in two steps: the initial formation and the going public part, where a SPAC goes through a traditional IPO, and then the second step where it completes a reverse merger and acquires an actual company with assets and cash flow, hopefully. Then we'll look at a SPAC IPO model, which is the step one of this process. Then we'll go through a SPAC merger model, which is step two of this process. Then we will look at a SPAC versus a traditional IPO and see how they change the ownership and result in different share counts as the merger is completed. We'll look at SPAC performance so far and explain why you're probably going to lose money if you invest in one of these things. And then we'll look at SPACs versus private equity and hedge funds and explain why all these asset classes are problematic in some ways, but SPACs are by far the worst. So let's talk about the process and mechanics first and start with part one, which is the initial IPO for a SPAC. So in step one of this process, the sponsor, which might be some random CEOs who are bored, some investors who are bored, maybe some celebrities who want to increase their net worth even more, this sponsor forms a SPAC and it purchases warrants to cover underwriting fees and other expenses. Now in step two, the sponsor gets a promote for 20% of this company's equity in exchange for a nominal investment, such as $25,000. So I want to be very clear here. Essentially, the sponsor is getting something for nothing. They have contributed almost nothing in terms of capital for what a real business is worth, and somehow they end up with 20% of the company's equity at this stage of the process. Now in step three, the SPAC goes public and sells units, shares, and warrants to gullible public markets investors. Then in step four, the gross proceeds from the IPO are kept in trust until the SPAC finds a real company to acquire, or until it dissolves if it can't do that within 18 to 24 months. Here's what it looks like in terms of corporate structure. So we have the SPAC sponsor on one side with one of these random celebrities. Then we have the gullible public investors on the other side, day traders and people on Reddit at home who think that they can make a fortune by buying shares in SPACs. Then we have the SPAC in the middle. Now, the SPAC sponsor purchases warrants and puts in minimal capital in exchange for 20% of this entity. The public market investors get to buy shares at $10 each and possibly buy warrants too. And they get a shell company that promises to do something one day, maybe, but if it doesn't, it'll just dissolve and they'll get their money back. Of course, due to inflation, after a year or two, they will get less than what they actually put in terms of the real value of that money. These public market investors get around 80% of the SPAC. Once all this cash is transferred, the SPAC keeps it in its bank account or a trust account or something like that and reserves it for use in a potential reverse merger if they find a real company to acquire in the future. Now, in part 2 of this process, this is where the SPAC actually acquires a real company, at least in theory. So in step 1, the SPAC identifies a target company and negotiates an acquisition where this real company becomes the majority owner of the SPAC. So in other words, it's a reverse merger where one smaller company issues so many shares that the target company actually ends up in control of the entire entity because it owns more shares, or it owns over 50% of the shares in the entire entity. In step 2, the SPAC shareholders get to vote on this deal, and if they don't like it, in theory, they can redeem their shares. Of course, that assumes that they can actually find buyers for their shares, so it assumes that there are actual other people out there who like the deal, even if these current shareholders do not. If the deal is approved, the target company merges into the SPAC and becomes public, and the cash on the SPAC's balance sheet pays for the target, or maybe it repays the target's debt, or maybe it's just kept on the balance sheet of the combined company. Also at this time, another investor might come in and put money into the post-merger SPAC via a PIPE or private investment in public equity, so the cash balance increases at that point. Here's what the diagram looks like. We have the SPAC sponsor, we have the real company, we have the gullible public markets investors, and then we have some other random investors who want to get on board the SPAC train and have this fear of missing out while everyone else is getting rich and they're not. Then we have the SPAC in the center. So the SPAC sponsor ends up with less than 20% after all this takes place because so many shares are issued to other parties. So they started with 20%, but they're going to end up with considerably less than 20% once all is said and done. The real company ends up in control of the SPAC because they own the majority of the shares once this takes place because the SPAC issues shares to acquire this real company. These gullible public investors, even though they started out at around 80%, they will end up with less than 50% of the SPAC because they get diluted down and the real company here ends up in control of this entity. And then we have these other random investors who might end up owning less than 10% because they make an investment as all this is taking place. The end result is that the SPAC gets even more cash from the PIPE and they can put some of it to use in acquiring the real company or in repaying its debt or in helping it expand or do something else like that. So the reason why SPACs are a racket, and in my opinion, a scam, is that the SPAC sponsor gets a huge stake in a real company in exchange for almost nothing. There's a really good Financial Times article about this, and I'm going to take one of their graphics here and link to the article so you can see it as well. If you can't get to it, just do a Google search for the name, and you can probably see a preview of the article like that. So here's an example for this one SPAC deal that took place from 2018 to 2020. So the sponsor here got around 20% of the SPAC initially for about $25,000. And then somehow this became worth $81 million. And then finally, once the merger was actually completed and the share price changed, it became worth $395 million, all for an upfront investment here of $25,000. And it's not because the actual company grew or because the sponsor helped it achieve some incredible multiple or greatly expand its business. This business already existed, and the sponsor here did absolutely nothing. They contributed nothing in terms of time or capital, and yet they got the stake that ended up being worth hundreds of millions of dollars. Let's go to part 2 now and talk about SPAC models versus IPO models, and I'll go into Excel for some of this part, but I want to lay out the assumptions first. So as with IPOs and IPO models, there isn't really much to model here because all that changes are the company ownership and the cash balance. A merger model is completely pointless because the SPAC is an empty holding company, so there is no accretion dilution. The EPS accretion here would be infinity because previously the empty holding company had no EPS at all because it had no net income. So let's use a few specific numbers here to illustrate what might happen in this type of deal. Let's say that a SPAC goes public and raises $200 million by selling 20 million shares for $10 each in the initial IPO, and the sponsor gets 20% as a promote here. Now, at the same time, the sponsor also buys maybe 4 million, maybe around 3 to 5 million, we'll say 4 million of warrants for $1 to $1.50 per warrant at a strike price of $11.50. And the fees paid for these warrants are supposed to cover the initial 3% or so underwriting fee on this SPAC IPO. Now, the underwriting fee here is split. So it's 3% upfront and then 3% deferred when the merger takes place, if the merger actually takes place. So in total, the 6% here is actually about the same percentage as in a standard IPO. So it's highly questionable whether or not companies really save money here in a major way by going public through a SPAC. Now, once the acquisition takes place, we can say that maybe they find a promising private company and they acquire it for a purchase enterprise value of $2 billion and a purchase equity value of $1.6 billion. And at the same time, they also recruit some other investors for a $100 million PIPE, private investment in public equity, into this entity. This may all sound confusing, but in Excel, it's actually not that complicated. Let's go in and see what this looks like. So here we have the IPO share price for the initial SPAC here. They're going to sell 20 million shares at $10 per share. We have the sponsor promote, we have the warrants that are being sold, and we have some of the fees over here. So the SPAC shareholders is easy. They are going to get these 20 million shares because they actually buy these 20 million shares for $10 each. Now, at this point, you might think that the sponsor promote just means that they get 20% of these existing shares, but that's not actually what happens. What happens is that they get newly created shares above and beyond these 20 million, all because of reasons I don't really understand, but they somehow get 20% extra shares. So the formula here is that we take the primary shares issued, we multiply by the sponsor promote of 20% here, and then we divide by 1 minus the sponsor promote to gross this up and to get 25 million shares after the IPO takes place. So the sponsor is getting 20% of this, or 5 million shares, basically for free or in exchange for a very nominal fee paid. Now for the IPO dollar amount, this is just the $10 per share times the 20 million of primary shares issued. Then for the post-IPO equity value, all the references I've come across seem to imply that post-IPO, the share price is still $10. And then even after the sponsor gets its promote, there are still 25 million shares outstanding. So somehow the equity value increases by 50 million here. We'll assume there is no debt because this is just an empty holding company. And then to factor in the cash balance here, we need to look at the fees as well as the cash received. So for the fees here, we will take the IPO share price times the primary shares issued. That's how much cash they get. But then we have to factor in the fee. So we'll take the IPO dollar amount right here, and then we'll multiply by the upfront underwriting fee. And then we will also add in the amount that the sponsor pays for these warrants, which we don't have yet. So let's go over and fill this in. We're assuming that the sponsor buys 4 million of warrants for $150 per warrant. So their cash contribution is about 6 million. Now we get a curious conclusion from this, which is that the post-IPO enterprise value here is around 50 million. And I don't really understand this, but we'll just go with this for now, and then I'll show you what I think should be happening in this scenario, even though all the references I found on SPACs seem to argue that this was in fact the case. At this point, it's also worth asking what the sponsor has gotten out of all of this. And the short answer is that if we go with this $10 per share price, and we multiply by the 5 million of shares they have, they've contributed $6 million of cash. And by the way, this is not for the shares. This is just to buy the warrants and to cover the fees. And they've gotten $50 million of shares in the SPAC in exchange for that $6 million contribution in the beginning. You can already see how this doesn't really make sense. But what also doesn't make sense is how the post-IPO enterprise value is anything other than zero, because this company has no operational assets at this point. So I don't really see how it could be worth more than zero. So what I think should happen here is that if we have 25 million of shares, then we should take the IPO dollar amount and divide by this and get to a lower share price, which means that the equity value is the new share price of $8 here times the 25 million of shares. And then we can link to the cash and debt once again. And this gives us an enterprise value of 0, which makes a lot more sense. The share price should go down if we magically just grant these new shares to someone else in exchange for no cash. Of course, we still have a problem here because even at this new lower price, the sponsor's shares are still worth 40 million. So they still have contributed 6 million to cover the fees and get the warrants, but their shares are now worth 40 million, even though this is an empty holding company. So this is step one of the process in Excel. And like I said, I haven't really been able to tell exactly what explains this behavior or what should be happening here, but this is my version down here, and this is what I found in references and presentations from banks and other sources. If we go down and go into step two, the SPAC merger. So let's say that the SPAC has now identified a target with 200 million of EBITDA. They're going to acquire it for a 10x EBITDA multiple. So the target's enterprise value here will just be $2 billion. We'll say they have 400 million of net debt, and so the target's equity value is 1.6 billion. Now, also at this time, there are going to be some outside investors that want to put 100 million into this company, and there will be a 3% fee on that. There will be a 0.5% M&A advisory fee here as well, so we have some additional fees when this takes place. For the cash to purchase target here, we have to take into account a couple things. First of all, we have the initial cash that was raised in the IPO, so the 200 million right here. Then we also have the PIPE investment, so this is 100 million, so we have 300 million total of cash available to purchase the target. What this means is that if the target's purchase equity value is 1.6 billion, we only need to issue 1.3 billion of equity to complete the deal here, and we're assuming that all the cash is used to purchase the target. So if we take this 1.3 billion and we divide by the $10 IPO share price, we'll just go with that for now. We need to issue 130 million of shares to acquire this target. If we look at what that means in terms of ownership here. So the SPAC shareholders still have their 20 million of shares. Now the sponsor still has their 5 million of shares, so we'll link to that. The PIPE investors put in 100 million, and we're assuming that they did it at $10 per share, so they have their 10 million of shares. And then the target company gets the 130 million of shares, so we have 165 million of shares total outstanding. And in terms of the ownership, let's go down and calculate all these. And so the target company here ends up owning around 78% before we include the impact of warrants. The sponsor is down to only 3%, but this still represents a huge chunk of value because look at how much this company is worth now. 3% of 1.6 billion here, or whatever it comes out to after the merger, is almost $50 million on an initial contribution of around 5 or 6 million or something in that range. And then if we assume the exercise of warrants, take a look at this. The SPAC shareholders still have their 20 million. Maybe they've purchased some warrants, but for now, let's just assume it's all the sponsor. So the sponsor's 5 million shares are here. They have 4 million of warrants, and we'll assume that eventually the company's share price rises and they can actually exercise these warrants. The PIPE investors still have their 10 million of shares up here. And then the target company still has their 130 million, and we can copy down all the ownership formulas here. And so the target company here ends up owning around 76 or 77%, down from 78 or 79% once you factor in the warrants. Let's now talk about what a SPAC versus a traditional IPO looks like and go through both these scenarios. And we'll assume that in the IPO, the stats are the same. So it's still an enterprise value of 2 billion, an equity value of 1.6 billion, and they still raise 300 million. It's just that they do so differently via the traditional IPO instead of going through this initial SPAC and then getting a PIPE investment right here. Let's start with the SPAC side and go to the target enterprise value. We will link to the target net debt and then sum these up. Then for the SPAC or public shareholders, the sponsor promote, and the PIPE investors. So we're going to keep looking at all this pre-warrant, and so that means that the public shareholders here still have their 20 million of shares, and we can multiply by the IPO share price, and we'll still go with this throughout. I'll anchor that share price, and then here we'll just copy this down to get the sponsor promote, and then we'll copy it down again to get what the PIPE investors have, so the 100 million here. Let's add up all these. And then for the cash proceeds here, this is just going to be the 300 million of cash that the SPAC used to purchase the target. And then for the transaction fees, so we have quite a few different things going on here. First off, we have the IPO dollar amount. And remember how part of the fees here were deferred until the SPAC merger takes place. So now we charge the rest of the 3% fees on this 200 million initial IPO amount. But then we also have the target's equity value and the M&A advisory fee that's charged on that. Banks will charge this fee as well, so this is 0.5%. And then in addition to that, we also have the PIPE investment and then the fee on that, which might be around 2 to 3%. We'll say 3% here. So we have all those fees. And then we have this, and we have our total value to existing shareholders in this real company. The implied ownership here is exactly the same as what we had for the pre-warrant ownership above. So I can just copy all those down and across. And then on the IPO side, we're still going to assume this initial target enterprise value of $2 billion, and we will still have the same $400 million of net debt here. So our equity value before any of this takes place is still $1.6 billion in both scenarios. The difference is that now we don't have a sponsor promote or PIPE investors or any of that. So these will both be zero. And then for this one, the SPAC or public shareholders, here, this is just going to be equal to the $300 million of IPO proceeds that we raise in this deal. So I'll go over here and say the equivalent IPO proceeds are equal to $300 million. So that's the main difference. Instead of going through this two-step process, we just raise all $300 million at once in the IPO, and then we can add these up. For the cash proceeds here, it's just the $300 million. And then for the transaction fees, we're going to say that it's the $300 million times the 6% right here. We have that. And so we still get to a total value to existing shareholders of something in about the same range, but it is higher with the IPO simply because we have fewer parties here and less dilution taking place. And then in terms of the implied ownership, here, the SPAC or public shareholders only get the $300 million that they've been sold divided by the IPO price of $10 per share. There is no sponsor, there are no PIPE investors, and then the target company gets the rest. So we're still going to assume those 130 million of shares outstanding. We can add these up, and then we can calculate the ownership for each of these. And so the long story short here is that the ownership tends to be higher in an IPO because there are fewer parties and there's less dilution taking place, and the total value to existing shareholders also tends to be higher. Yes, an IPO takes more time, there is more regulatory scrutiny, but in exchange for that, the company also keeps more of itself, and the difference could be substantially larger than what we're actually showing here. So that's a little bit about SPAC models or so-called SPAC models. Let's talk about performance so far in the market. Now, you read a lot of stories about companies' share prices doubling or tripling or going up 10x or even higher, and there have been a record number of SPAC IPOs over the past year or two. But if you look at the average or median here, it's around negative 40% or negative 50%, somewhere in that range if you look at a 3-month, 6-month, or 12-month period after the merger takes place. And I'll link to my source here. You can go read this paper yourself. It's quite lengthy and detailed, and they've done an extensive study of SPACs and IPOs and SPAC versus IPO performance. Now, people often counter this, and they say that traditional IPO performance is also quite poor, but I think there is a big difference, which is that with an IPO, you know what you're getting. The incentives are clearly laid out. There's no magical sponsor promote that results in celebrities receiving huge percentages of this new company for nothing. SPACs promise that companies can go public more easily, which is sort of true in that they can go public more quickly this way. And they also promise lower fees, which, as you saw, is not really true. It's just that the fees are distributed and spread out differently, but they're not really lower in percentage terms. And the company gives up a lot more of itself, so there's more dilution with a SPAC. In short, you're giving up a chunk of your company to a random celebrity in exchange for almost nothing if you choose to go public with a SPAC rather than an IPO or even a direct listing. If you compare SPACs to private equity and hedge funds, people often complain that the 1 or 2% management fees are a ripoff and that the 20% carried interest is too high. And I think there is some truth to this. The fees are probably too high, which is why the management fees have actually been falling over time. But there are also some big differences here with these vehicles compared with SPACs. First off, with private equity and hedge funds, you're putting your money into a team with a track record of investing in a certain industry, and they're going to invest in many companies and many deals and many assets, focusing all the money on a single company and betting on its success. Also, the team is putting significant amounts of their own money to work in the fund, so they have some skin in the game, and they're highly incentivized to perform well. This contrasts very sharply with a SPAC where the celebrity or sponsor is really putting in almost nothing compared to the total value of the company that they're looking to acquire. And then the other difference is that it takes many years for PE firms to earn their carried interest. So even if they have investments that perform very well, until they get to the later stages of the fund lifecycle, they're not going to be able to actually get that carried interest until the financial results are known. That's about all I wanted to say on this topic, so let's do a recap and summary now. SPACs, or special purpose acquisition companies, promise to allow normal companies to go public more easily and with lower fees. They also have this promise of making it easier to invest in previously private companies and making the whole market more accessible so retail investors can also participate. But the truth is that the fee point is not really true. The total amount of fees is not necessarily that much different as a percentage, and the SPAC sponsor gets a huge chunk of the company in exchange for doing almost nothing. Post-merger SPAC performance tends to be awful. Yes, there are some standouts and some that have done much better, but in general, it's pretty bad performance all the way around. Yes, IPO performance is also bad, I agree with that, but at least with IPOs, you know what you're getting yourself into, and you know that the SEC or other regulatory bodies have at least reviewed the company's filings. So the bottom line is that if you buy into SPAC shares, you are essentially gambling because there is no company, there is no underlying asset, there is no cash flow. You are placing a bet that a random celebrity or board CEO or other business person will be able to find some company in the future, acquire it, and then somehow make it more valuable and actually do something with your money that is constructive, even though they have no real track record to go on in most cases, and you have no idea what they're actually going to do with your money at all. So who knows how long this will continue, but my prediction is that, like other manias in the financial markets, this will all come crashing down at some point as people realize that SPACs are a ripoff for pretty much everyone except for the celebrities who keep benefiting from them and raising a lot of capital from them.